All right, let's jump right into it. I've got attorney Frank Miranda on the show today. Hey, Frank, welcome back.
Hey, it's great seeing you after a long hiatus.
Yeah, man. Thanks for coming back.
But I think you guys have enjoyed Lauren from the office in the interim, though.
She's done a great job, I tell you. Very knowledgeable. I love her style. She's definitely a great team member. I know with you guys have a great team over there as well. Stephanie Rosario does an awesome job on the title side and just kind of general management, I guess, with the team. I love having you on, Frank. We like to talk about these different scenarios, kind of ask an attorney type scenario here. A lot of things coming up, a lot of things to talk about. Where do you want to start, my friend?
Oh, we can start anywhere. I think what we're going to see in the consumer side is there's been a moratorium because of COVID, federally backed. That ends June 30th. That doesn't mean, and that means that's for all federally backed mortgages. So I think what's going to happen is you're going to see not as big of a fluctuation of, or I should say, an infusion of foreclosure homes on the market after that time frame. You're not going to see it as big as you saw it in 2006, 2007, but you're going to see it. And that doesn't necessarily mean because they're available in the foreclosure markets that banks are going to accept a lot lower than market value prices, because they're not going to, because it's a different scenario here. In this scenario, we have plenty of people with money. We have plenty of people that have some experience in real estate, and they see the opportunity here in the Tampa Bay area. So you're going to have a possibility of more inventory, not necessarily a reduction in price and a sales price, but banks know what's going on here, and there's too many people moving here from up north.
Yeah, exactly. So they're going to. It's not going to be a flood in the market. You're saying it might be kind of benched out. I remember that back in the day too. They would kind of just slowly release them out in different, tranches or almost like, buckets on a sheet where you're looking at a rate sheet for lending. It seems like they would slowly release them out at a strategic time.
I don't think they're going to have to do that because I don't think they're going to have the volume they had last time.
Right.
Okay, so last time they had so much it couldn't handle the situation. This time I think it's going to be manageable by the banks. The exception is going to be they know there's value in those properties, and you're not going to be able to pick them up 50 cents on the dollar. They know there's enough buyers out there currently looking and that are willing to put money into a property, to have the funds to put it into a property. So I think you're going to have more inventory, not a ton more, but more inventory at the same market prices. In that event, what happens is if there is additional funds after the payoff of the mortgage, the initial owner will get those proceeds, which will help them on down the road to find their own place to live.
Yeah, and let's take that a step further too, Frank. When you look at back in the day too, they had this relief for the homeowner. I think a lot of that has run out in terms of if there's a homeowner that gets foreclosed on, they are responsible now for that whole difference. If the property has a higher lien than they could actually sell it for.
Yeah, that doesn't exist any longer.
Right.
The distinction, at least in this area, okay, you may see that in other parts of the country.
Yeah.
But in this area, because we have so many buyers coming in, I think there'll be equity. I think there's going to be a very small percentage in this area that may be upside down on their house. I base that on that the property values have been steadily going up over the last few years, probably over the last 10 years. So I'm assuming that based upon the fact that property values here have held and are going up, that they should be okay. If they don't walk away with money, they should walk away even. And so I don't think too many people are going to get burned in that scenario. Yeah,
the only way I think you might see it with condominium associations. They can get pretty aggressive with their fees and their dues if they stop paying on those. That might be a scenario where people would be in trouble there.
Yeah, and so what happens in that scenario is this. So if they're not upside down on the mortgage, but they owe, let's say, $10,000 in the HOA, the clerk of the court who takes the money in a foreclosure sale, they're responsible for paying out the subsequent lien holders to the property. So then the HOA would get paid. So then instead of the property owner getting the $10,000, whatever's left over would go toward the HOA.
Yeah, and that's a hard lesson for some people to learn. They think, okay, well, I could remember back in the day they didn't have to pay their mortgage, or they knew they had some leeway there. And even when you wanted to try to get a loan mod, the banks, if you call them up, try to work with them, they'd say, well, you're not behind on your mortgage, so I can't really help you yet. So it was almost like they were kind of saying, well, you got to miss a couple payments, then we can negotiate. But that's not the case with these HOAs. They can start foreclosure processes. Can you talk about that dynamic with the homeowners association, the condo association, and how some people kind of miss the ball there?
Okay, so what I've experienced with an inexperienced investor, they want to go and get involved in real estate for whatever reason. They see on the foreclosure docket, which the sales are now all done electronically, and you bid electronically and whatnot. They see a piece of property and they see a bid of $20,000, where everyone knows that no matter what the property is in this area, everything's worth more than $20,000. Even the most undesirable pieces of property are worth more than $20,000. So these guys buy this, and they don't realize it's not a mortgage foreclosure sale. This is an HOA. This is a condo association sale. What that gives you is only one thing, the right of possession, okay, and ownership. However, you're buying it subject to the mortgage. So then what happens at that point in time is you spend $20,000 and maybe you even improve the property, another $10,000 into it. And then 6 months down the road, you get served with an eviction lawsuit. A foreclosure lawsuit from the bank saying we're wiping you out. Okay, so back in the day, what some investors would do, they would know it would take so long to get a foreclosure done, as they were willing to roll the dice because they were collecting more rents, and then they would walk away from the deal. Okay,
right.
And they would stick a tenant in there, and they were just collecting rents. I don't see that same scenario happening again. I don't see the backlog on foreclosures because I don't see the same volume that happened 10, 15 years ago.
Yeah, I agree with you. Frank Miranda here, attorney Frank Miranda here on the Consumer Quarterback Show. I'm your host, Brandon Rhymes, and kind of pitching and catching here about real estate law. Let's switch gears. Let's talk a little bit about that landlord-tenant relationship, Frank. What are you seeing in that space in terms of the evictions?
Okay, there's a misnomer out there. The only moratorium on a eviction has to do with whether or not it's quote-unquote COVID-related. What's not COVID-related is if you have a scenario whereby on its terms the lease itself expires. So if you have a year-to-year tenant and that tenant lease expired, in my scenario, January of 2021, that tenant claims, I don't have the money to pay you and remains there, I can still evict them because the term of the lease itself expired. It has nothing to do with COVID. And so in that scenario, you could still get an eviction. We are a consumer show, but, the owner of the property is also a consumer of goods, too. They're the ones that borrow against, put the property up and get a mortgage. They're the ones involved in the business. So it's not just the tenant that thinks a consumer. I think also the landlord can be considered a consumer because they're in the course of business. And so they're being damaged by someone who can't pay them a rent. They can't pay the mortgage, and it trickles down to a problem for the bank. So the whole scenario needs to be cleaned up, and they need to find someone that could pay rent so they can pay their mortgage. So it's a situation, much like any other situation in the economy, where one segment falters, it kind of trickles down to the rest.
Right. Yeah, absolutely. Landlords had a tough year last year with, the extension after extension of that rent money not being collected. That was a tough year for them.
Hey, listen, and banks need money too.
Yeah.
Banks can't lend out money and not collect. It doesn't work that way. Banks have investors. In fact, a lot of people in this world are invested in, whether it's through their 401k or whatever, they have a segment of an ownership of a bank, and they're counting on that money for retirement one day. So, like I said, it all trickles down some way or another. You can trace that dollar, and it touches everybody.
Yeah, absolutely. It's interesting how it's all interconnected, intertwined, and yeah, there's a lot of speculation. I know Ray Dalio just came out with some information. I can't remember if it was on a podcast or a blog or something, but Ray Dalio, one of the the most famed investors of all time, just said, "Hey, look out! We got low interest rates." The liquidity that's been injected into the market, what's going to happen with the stock market. He's calling for a potential crash here, pretty soon. I think, I'm not sure if he used the term crash, but something along those lines. Because if you look at, what the stocks have been doing, they've been issuing a lot of debt. So they're using that debt to buy back their own stock, and that's falsely inflating the earnings and the yields on some of these stocks. And it seems a lot of people think it's a kind of a house of cards, a house built on cards, Frank.
Well, I think it's been like that for a while, and so I think historically, and I think there's too much that gets talked about when it comes to politics, and this person's good for the economy, bad for the economy. At the end of the day, businessmen are running the stock market because they all want to make money, whether the left or the right are in power. At the end of the day, whoever has stock options is going to want that stock to be as high as possible because they're buying that option so low. So these guys are smart guys. A lot of them went to Ivy League schools, and they're going to play their own game, what's good for them, and manipulate the system, what's good for them. That all being said, historically, there's always a cycle, right? You can't go up forever. And then when there's a downslide, there's another opportunity. And then there's a downside in real estate. There's an opportunity if you're sitting on cash.
Yeah.
So if you're sitting on cash and a house is once worth $350, now you can pick it up for $275. You're going to make money.
Yeah.
And so that's never going to go away. Those ebbs and flows are never going to go away. And there's always smart people to figure out how to work things out. If things are to turn south, someone's going to make a profit on it.
Yep, that's it. Got to have a plan. We'll help you get your plan in place right here on the Consumer Quarterback Show. When we come back, more from attorney Frank Miranda here on the Consumer Quarterback Show. Stay with us. Plus, our feel-good story of the day. We always want to do a feel-good story and let you know something positive here happening. But interesting story here. Volunteers pick up 15,000 pounds of trash from the Tennessee River in 2 days. Stay with us right here. Consumer Quarterback Show, consumerqb.com.
This is Work Done, and you're listening to the Real Estate Quarterback Show hosted by my man, Brandon Rhymes.